Right, Larry, firstly, thanks very much for taking time out to chat with us. Now, to begin with, how optimistic are you that EU leaders will actually be able to come up with some solution to get the mess that the Eurozone presently is in behind them?
Well, thanks for having me, George, first of all. I think in terms of the EU, this is unfortunately a situation that's still going to take a significant amount of time to resolve. I think we've had something like 26 or 27 summits already, EU summit meetings on this issue. I suspect we've still got at least half that many more to go, but it does feel like the policymakers are now finally starting to, number one, get serious about the issue, and number two, they're starting to talk about solutions to the issue that are more in line with how the financial markets have already discounted the situation.
Greece seems to have averted a crisis, at least for the time being. But how likely do you believe it is that peripheral economies like Greece may ultimately be forced to leave the euro, to exit the euro? And there are already people who talk about Greece likely being better off if it went back to the drachma.
Yeah. Well, I think, of course, if Greece left the euro, they would have an additional tool to potentially help solve their fiscal issues, which is the devaluation of their currency. If they were to return to the drachma, that would give them that additional tool. Having said that, however, I think this again is the balance that the Greek government is trying to weigh today between being part of a more substantial economic union, the EU, a more of a substantial economic entity, as compared to being on their own. And I think at the moment it appears that the sentiment and the government still believes that being part of the larger European Economic Union is a net positive for Greece.
The markets now seem to have factored in the likelihood of a Greek default. The focus now seems to have shifted to Italy, Portugal, and Spain. There's a lot of concern about those economies getting into far more trouble than they are already in. Would you say that that's the bigger crisis, that Greece isn't really so much of a problem?
Well, I think Greece is symptomatic of a larger problem that you also see in Portugal, Italy, and Spain. And that is really the problem that the governments there have promised more to their citizens in the form of benefits, either retirement or health care benefits, than what their economies can actually support over time. And ultimately, there's going to have to be a rationalization of that, and the sooner that those governments get in front of that issue and align their benefit programs with their ability to pay, I think that's how they're going to have to avoid these issues. And so it's going to take the political will to make those hard decisions in order to avoid the crisis in those peripheral economies.
Do you believe one way of addressing Europe's problem is by getting countries in the region to exit the lavish pension system that they presently have and adopt a system that's more on the lines of the US's defined contribution system?
Well, I think we have to be careful that we don't try to adopt simple solutions to complex problems. But having said that, George, I think that you are talking about an item here, which is pension systems that are a meaningful contributor to the economic issues that many of the European countries face. They made the decision decades ago to provide more in terms of health care and retirement benefits to their citizens than other countries throughout the developed world, including the United States, although we as well have made significant promises and we have a lot of tough decisions. But when you look at the emerging economies in Latin America and in Asia, they have not gone down that path, and as a result of that, you see faster economic growth, and that is very likely to be what to see in the future.
There's a whole lot of concern about the sovereign bonds sitting on the books of banks. Now, banks, in order to allay fears of investors, are trying to get rid of some of those bonds sitting on their books. Do you believe in their desperation to get rid of these bonds, they are in some sense precipitating the crisis?
That's a great question. I think, again, the financial markets have already moved ahead and have already begun to tell us what this solution is going to be. Because, again, when you look at the financial markets, you can see, for example, at least I know as of a couple of weeks ago, Greek bonds were trading at something like 42 cents on the dollar. So the financial markets have already significantly discounted this. I think we don't yet know if every bank were to take a haircut of that magnitude, I think we don't yet know, George, just how meaningful that would be for certain banks. Again, there isn't the optics and there isn't the clarity of understanding around that we need in order to really get our arms around this situation.
The new 50% write-down, or the 50% haircut that EU leaders have spoken of for exposure to Greek debt, in some sense is technically a default, though it doesn't acknowledge that it is a default. When you have a situation like that, isn't the whole, the purpose of a CDS that's issued to protect someone's exposure to those bonds, doesn't that really become meaningless? And aren't EU leaders essentially telling the investor that, look, if you've taken out a CDS, you've wasted your money because this is how it's going to be?
Yeah, it's a fascinating area. This is a fascinating area. And in some respects, it's been part of what I think the policymakers have been struggling with in trying to arrive at a very narrow solution to this problem, which is to argue on one hand that there should be a haircut on debt, particularly Greek debt, but that somehow that does not technically trigger a default. And I don't see how you really have it both ways. Now, I'm not a financial markets expert or trader. We're a company that's more impacted by the financial markets, but it seems illogical to me, George, that you can have it both ways, which is to say, on one hand, there's been a write-down of Greek debt, but on the other hand, to say that is not a default that would necessarily trigger the CDS, if you will, insurance that many financial institutions thought they purchased.
Do you fear that if the euro situation worsens and more countries in the region get perilously close to a default, and EU leaders come out with some sort of a solution like what they've had with Greece, do you fear then that the CDS market, in some sense, at least in the euro region, could be killed?
I think the CDS market in the euro region could be in for significant strife. Let's just say it that way. I think that's why you see the discussion today about the EFSF, which is the facility to sort of backstop some of this. I think they're trying to use that facility to get in front of the issue so that there won't be the more legal question and the more technical question as to whether there's a default. So that's, I think, the purpose of the European Stability Facility, as I understand that.
Everyone insists that the US is pretty much out of the woods, though you are going to see very slow economic growth over the next maybe couple of years. But if the Eurozone is going to slip back into recession in 2012, as everyone believes it will, do you worry that the cascading effect of that on the US could mean that the US could also slip back into recession?
Yeah. My view, George, is that whether the U.S. slips into recession or stays in a growth mode is not going to feel very different one way or the other. We will be in a bit of a two-track world for the next couple of years. That is, the two tracks being the emerging economies, probably with GDP growth rates in that 6.5–7% range, and the more developed economies with GDP growth rate anywhere from 1, maybe 1.5 maximum to perhaps -1. So whether it's +1 or whether it's -1 in the United States, I don't think is going to feel very different. So again, I think it's less relevant whether it's a technical recession. The point which was in your question, it's going to be a very slow growth kind of environment for the U.S. and for Europe for the next couple of years.
Ever since 2008, we've seen the global economy getting hit by one crisis after the other. Every 3 to 4 months you hear of something. We've had central banks cut interest rates pretty much down to zero levels. You've had quantitative easing even in some of the developed economies. Do you worry that if this continues, and the fact that central banks have pretty much run out of ammunition, the end game of all this could be unduly high inflation?
Well, I think that is very much of a risk, and let me give you an example. If you think where we've already seen this happen, certainly I think our belief is in the United States when the Federal Reserve went into their QE2 program, what that created, I think perhaps inadvertent, although it should have been perhaps seen. But what it created, George, was a bubble in commodities. The QE2 easing caused commodity prices to increase significantly, which then drove up the price of commodities, including oil, which then drove the price of gas up in the United States to $4 a gallon. And $4 a gallon of gasoline, starting in the early part of 2011, did more to kill the economic growth that was then going on that we saw in the first quarter. It did more to kill it than anything else that I can think of. So the Fed, through its quantitative easing, actually ended up hurting the economic recovery of the United States in a significant way. So I think the takeaway in that, George, is that the Fed has likely done all that they can do around trying to create better economic conditions for growth. They simply need to stand back and let the economy recover on its own without creating inadvertent bubbles in other places.
Focusing on the subject of financial innovation, which has helped create trillion-dollar markets, everyone seems to agree that the progress of the global economy is driven by the financial markets. But today you have a situation where governments are beginning to intervene in financial markets. There is the threat of overregulation. How difficult do you believe it's going to be to strike a balance between government presence in the markets without upsetting the free market, and how difficult do you essentially believe it's going to be for both sides to strike a balance without causing long-term economic damage?
Yeah, again, another great question. I've been in business now for over 40 years, George, and I can tell you that every time that there is a crisis, the natural, almost inevitable result is going to be some degree of overreach and overregulation. And I think we're seeing that again in the United States, at least in the context of Dodd-Frank. So I do worry about overreach and overregulation, and I do worry about the tipping back and forth of the balance between allowing free markets to work and not overregulating. So, for example, in the United States, the best example I can give you that I personally believe is overreach is what we call the Durbin Amendment. The Durbin Amendment basically gave the Federal Reserve the authority to set the fees for customers using debit cards. And that was not done because of any particular problem. It was not done because of any particular issue. It did not cause the financial crisis. It was done because the retail industry could use the financial crisis as a lever against financial institutions to take away a significant source of revenue. So again, had nothing to do with the financial crisis, but became sort of a centerpiece, an overreach as it relates to Dodd-Frank. And so it was really money passing between from financial institutions to retailers by limiting the fees on debit cards.
Right, now just focusing on Asia and China in particular. China has now spoken about trying to focus its economy more on domestic consumption, trying to reduce its reliance on on exports and the global economy. What they are essentially talking about is moving away from a trade surplus position to a trade deficit position. Do you expect that China's ability not to invest so much in overseas bonds, US treasuries in specific, could essentially make progress in those markets that much more challenging and lead to a quicker rebalancing of the global economy?
I think that it's in everyone's interest to see China create a more domestic consumption economy, and I think that they're on a path to do that. I think the result of that will be less capital by the Chinese, which is going to be focused on U.S. Treasury bills. I believe, however, again, non-economist, but I happen to believe that's going to be a plus for everybody. I happen to also believe that sometime, approximately in the next 10 years, we are quite likely to see the yuan become a second global reserve currency. I actually think that would be a positive for the global economy, because I think it will diversify and distribute capital more evenly around the world, rather than seeing it today, as we know, seeing it all flood to what's considered to be the one safe haven, which is U.S. Treasuries. And I think, again, if that global capital were more evenly distributed around the world in at least two or maybe even three reserve currencies, that the world's economy would benefit as a result of that.
Focusing on investment flows, we've got billions of dollars of idle money essentially sitting on the sidelines looking for investment avenues. What do you believe it is that's holding it back from flowing into emerging markets like India?
It's a great question. There is a lot of money sitting on balance sheets. I think most of that is actually sitting more on corporate balance sheets as compared to individual balance sheets. I do believe there is a sort of crisis of confidence as it relates to retail investors, But I think the bigger issue is the cash that's sitting on corporate balance sheets. And I think the issue there is that the managements of those companies, while I think today they would consider their financial situation to be stable, I think there remains a very high level of concern about whether economic activity is going to be picking up enough that they'd feel comfortable investing that capital today, or whether they still see enough challenges out there in not only the financial markets but the economy that they actually feel they're better holding that capital in reserve rather than investing in that next project because of the uncertainty about what direction the economy is going to be going.
That's the corporate investment side. On the portfolio investment side, do you believe, most investors have numerous concerns about Asian markets, and that's really the reason that's holding them back from coming into these markets? Or do you believe that most of those investors believe that these markets are overbought?
No, I don't believe that they think these markets are overbought. I think they still lack the significant familiarity with them, that they're willing to be as invested in them as they need to be. We happen to believe, quite frankly, George, that investors all over the world, whether it's U.S., Europe, or even in other markets, are underinvested. They're underinvested in emerging economies. If you take the total of the emerging economies today, they are now pushing 30-35% of the world's capitalization. So that would say, all other things being equal, that would say that a typical investor who is looking for a globally diversified portfolio would have at least 30% of their assets in the emerging markets. I would tell you, from the standpoint of someone very familiar with the U.S. investor and with particularly 401k investors, my guess would be at maximum you would see a 401k investor with maybe 5 to 8% of their assets at most in emerging market economies. So we believe there will be a significant flow of capital into the emerging market economies over time, but it's going to take the emerging market economies and the markets to kind of settle down a little bit and show some stability so investors will feel more comfortable as that capital flows into those markets. But over time, that's going to be a very, very big deal, and certainly something as a business opportunity we're trying to take advantage of.
Do you still believe that if we do see Europe slip back into recession in 2012, as we just spoke about and many people believe it will, do you believe that could act as a trigger to accelerate flows into emerging markets?
Well, what typically happens, as you know, is when the more developed economies have an issue, the emerging markets, not necessarily the emerging economies, but the emerging markets often react much more negatively to that. It's that flight to safety that we were talking about earlier. So the money tends to flow into the more established economies and it flows into the more safe investments. I think that's what's going to happen again. Again, we're not at a point yet where we have established other safe havens, such as other global reserve currencies. So all of that money is going to kind of flood back to the U.S. and it's going to flood back into treasuries for the most part. This is going to have to be a multi-year process to work out. But I want to emphasize again, we do believe over time the emerging market economies and the emerging markets are a great place to invest money for the long term.
Sure. So you're saying that Europe slipping back into recession next year is bad news for Asian equities? I
do say that Europe slipping into recession next year is likely to be bad for Asian equities in the short term. Now, on the other hand, if you had a very long holding period, that would be 10, 15, 20 years, I think as that happens next year, I think it's a great buying opportunity. So I think there is the opportunity to use the stresses and strains of the global economy to your advantage from an investment perspective, and to look for those dips, look for those declines in the Asian markets and buy on those dips. I think that's a great opportunity for people.
Now, just focusing on principals operations in India, if you could just tell us what you've got planned here. And before we get to that, India's pension system, that's been rated as one of the worst in the world. Now, coming from an economy which has one of the soundest pension systems, even if it has some of its flaws, what would your advice to us be?
Well, India does have particularly a pension challenge. There are only about 12% of people in India who are covered or are currently today saving for retirement. India is a country that will have 583 million people in the middle class by 2025. So 600 million people in the middle class, and at most 12% of them are saving for retirement. So you know, there are going to be no particular easy or simple answers to that, but what we do know is that the sooner solutions can be put in place, the more effective they can be. I think we have learned, George, from our U.S. experience, and as well as observations that we, Principal, have made of other retirement systems throughout the world, we do believe that an employment-based system, an employer-based system, is the most effective and the most efficient type of system that can be adopted for a country who wants to be very serious about making retirement reform. So I think I would start by thinking about what employer-based solutions could be put in place here in India.
Would you say that you're a little disappointed with the pace at which a regulatory change on the pensions front has progressed?
Yes, we are a bit disappointed. We've been in India since approximately 1995, and our entry here was premised on a belief that within sort of the first 5 to 7 years of our time here, we would see pension reform in some form or fashion come to this country. And that's, of course, now been 16 years. And while there have been some things around the edges, and particularly there have been some things for public sector workers, there's really been nothing done of substance for the private sector, which is so key to India's economy.
Just focusing on Principal in India, you've got an asset management company that you've got in partnership with the Punjab National Bank. If you could just tell us a little about what you've got planned over there in terms of expansion.
Yeah, well, we've had a very successful partnership with Punjab National Bank. They're obviously a very well-known, well-respected financial institution here, the second largest bank in India. So they bring great name brand, and they bring great distribution reach to our joint venture. And so we look forward to having the opportunity to continue to deepen and strengthen the distribution relationship and the brand building that is contained in PNB Principal Asset Management Company. However, in a market that's as large as India is, it's also necessary to pursue other distribution channels besides just the bancassurance distribution. So, as you know, there are developing here some interesting financial advisory channels, and ultimately we think there is an opportunity, even in the absence of a formal retirement system, we think that there will even be forward-thinking employers here in India who will begin to work to create more retirement-based platforms for their employees to save.
Everyone who's come into this market from outside has spoken about the huge untapped opportunity that the asset management space offers and even the pension space offers. But we've seen over the last few years that it's just about 5 or 7 players that have cornered a large part of the market. You've got nearly 40 players in the asset management business. Do you believe it's going to be that easy to get a meaningful share of this market?
It's very difficult to get a meaningful share in any market, George. All markets are competitive. Capital flows very freely in a global environment like we have. So we know that it's going to be difficult. The question would be sort of what would we bring to the market here in India that would be unique? And so maybe I would point out a couple of things related to that. Much of our activity in our businesses around the world is not really focused at the high net worth market. And that's where most of the AMCs that you're talking about, and particularly some of the ones that have been successful, that's where they're targeted, at very high net worth individuals. And what we try to do is to create investment solutions that actually can operate and be effective for more of the middle income and upper middle income person. That's the person who knows they need to save, but they're not a financial expert. And so we can bring very sophisticated, globally diversified investment solutions to them using not only our asset management expertise in here in India, but also the global asset management expertise of Principal Global Investors to allow local Indian investors, by being in a single mutual fund, to have an appropriate globally diversified portfolio. So that's the unique value that we, as Principal Financial Group, can bring to the Indian market.
Right, Larry, thanks very much for taking time out to chat.
A real pleasure to be with you, George. Thank you.